Let me confirm this is on. Excellent. Welcome, everyone, to the Montgomery Summit presented by Macquarie. I believe we are the first official session of this year's conference, so thank you for waking up early and joining this exciting panel on Liquidity Outlook 2020. We did a similar panel last year, and the conversation was excellent in terms of the panelists providing perspectives from a multitude of different liquidity options, and this year it will be no exception. I'm joined on my left by Alex Dyner from Cloudflare, and Alex heads special projects at Cloudflare and is responsible for the company's strategy, corporate development, and partnerships. Next to him is Jeff Thomas from Nasdaq, who is a senior vice president of Nasdaq's corporate services business. Jeff oversees Nasdaq's new listings and capital markets businesses. And next to Jeff is Paul Barber from JMI. He is co-managing general partner of the firm and has been working with software companies for over 30 years, including having served on over 25 private, public, and nonprofit boards. So please join me in welcoming our panelists to discuss liquidity outlooks for 2020. For the next, for the format for this session, we will start with, I have a couple of questions I want to ask the panelists, and then we will open it up to the audience for Q&A as well. So as we're going through the session, please jot down your questions. We will have an opportunity at the end for you to ask questions as well. The first question I'd like to start with is the item that is certainly dominating news headlines over the past several weeks, if not longer, which is the coronavirus, COVID-19. It's having a global impact, including on manufacturing in Asia, decrease in inflation in the Eurozone, and as we all observed yesterday, an emergency Fed rate cut here in the US, the first since the global financial crisis. What would be interesting for us to hear is what impact each of you are seeing on your respective businesses. Perhaps if we can start, Paul, with you, and impact to portfolio companies at JMI and making investments and assessing risk in this market.
So good morning, everybody. JMI Equity, we're growth equity investors in software companies, all B2B, all cloud. They're generally companies that are 10 million in revenue or higher. They're all private companies. We have a portfolio of 29 companies. They're all basically in the B2B space. So it's too early to tell, for sure. Certain end markets are going to have more, you're going to see it more. Most of our companies are automating some under-automated process that helps run a business. So hopefully they're pretty mission critical, but it's way too early to tell. The last downturn, new went away pretty quickly. That can also come back pretty quickly. But recurring revenue is a good thing, but it's way too early. It's way too early to tell. And certainly on the investing side, all the entrepreneurs think of the high. They don't ever think of the low. So we're out there competing every day. And if there is a change in pricing, it will take months or quarters to play through.
And Alex, maybe if I can bring the question over to you. At Cloudflare, you're evaluating a multitude of different options, both organic and inorganic, from a global basis in terms of geography. What impact may the recent outbreak be having on how you think about strategy, geographic expansion, and overall M&A landscape?
Yeah, I can talk about a bit about who we are, what we do, and then kind of answer your question as well. So we run a network of over 200 data centers around the world, and we protect our customers from all sorts of cyber attacks, improve the performance of their websites, applications, APIs, and then make them more reliable so they don't go offline when there are attacks and whatnot. So we proxy about 12% of the world's websites and applications, about 27 million domains. Most of our business, about 50% of our business by revenue is outside of the United States. We have 13 offices around the world, and most of our employees are also outside of the United States. So what we're doing internally for our team is what we're saying is, in general, follow global guidelines. So there are a certain number of countries, China, Japan, Korea, Italy, Iran, where if you travel to those countries and you try to come back to your country, in most parts of the world, you're going to be quarantined. So we say, don't go to those countries. But for that, kind of use your discretion. Speak with your manager. Use your discretion. If you're not, if you don't have to go somewhere as part of a critical meeting or business function, you should probably err towards not making that trip. But we're also not stopping business, and so we're continuing to do what we need to do to run a business. And then sort of to answer your question in terms of geographical expansion. Like I said, we have 13 offices today. Recently, we opened an office in Japan, hired a Japan general manager, and we're looking to expand in Brazil this year as well. I think it kind of depends on the situation. So we operate quite remotely, right? And so if we were sort of 3 or 6 months prior and in the process of interviewing this Japan general manager, would we hire him without doing an in-person interview? No, right? We'd want him to come in and meet the team in person and get to know him that way. So that would have delayed us a little bit, right? But are we going to stop him from hiring people that he has experience with and knows and tell him, no, you should stop that process? No, we'll probably tell him, do those interviews through Zoom or through G Suite and continue that way. So we're sort of, we're both playing it as it comes. We're communicating a lot with our own employees. Every 2 days we send an email out with updates as to kind of what we're seeing different policymakers do and how we're sort of following that. And then on the strategic side, we're continuing business, continue to expand geographically and globally, but we're expecting people to use good judgment, and where there are kind of global guidelines, we'll follow those.
Thank you. And Jeff, turning it over, the question to you, what impact are you seeing yet, if any, on outlook for IPO listings, the outlook for 2020 as it relates to the IPO market?
Sure. So take a big step back around who Nasdaq is, what we do. Everybody knows us as the U.S. stock exchange. We actually run 13 different markets around the world, including the Nordics. We sell our exchange technology to over 100 other marketplaces around the world. So we run exchanges like Hong Kong, Australia, Dubai. So we have this really interesting view into the market, both through the markets that we own and operate, as well as the markets that we help support through our technology solutions. So one of the things that we've seen, obviously, is the volatility. The VIX index is going through the roof here in the U.S. The good news for Nasdaq is that means that there's a ton of volume. And so our fixed costs on our exchange businesses stay the same in those kind of times, and we see a lot more trading, so we get a lot more revenue in that. The other side of that is, companies don't want to go public when the VIX gets above 20. So if the markets are too volatile, it's tough to go out and get investors to pay attention to your story when they're constantly checking their Bloomberg terminal to see, what's happening to their portfolio. So we've already started to see a handful of deals push their roadshow back a week, 2 weeks. Warner Music announced that. Cole Haan announced that. We had a couple other large companies, ZoomInfo and Accolade, file publicly last week their S1, which typically means they're going to start their roadshow 15 days later. So we're watching those to see what their decisions are. But so it's really kind of day by day, week by week on that front. And this is all against a backdrop of what we had seen was a big acceleration, because everybody wanted to get out in the first half ahead of the election cycle. So we just got through Super Tuesday. The fields are starting to get clarified. Things will start to be a little more certain on that front. So, if I look forward, if we get through the coronavirus, crisis, and it gets to a more steady state point, the date of the election is fixed. So that could lead to a very busy summer if things kind of settle down, where you had a lot of deals kind of accelerate to speed up, and then they get put on pause, and then they still have that kind of deadline where they either want to get out ahead of the election or then potentially pushes them to 21.
And Jeff, you mentioned having seen an acceleration of deals to hit the window. Can you comment on, perhaps this is a good segue into Q3, Q4 of last year in the IPO market? There are some notable deals that perhaps did not successfully syndicate. WeWork is obviously a great example, but what impact that may be having on the pipeline today, and what impact that may be having on the criteria that equity investors look for in companies that do come to market?
Yeah, if you look at it, Nasdaq IPOs as a class last year were up 24%. So still very attractive. We still see a lot of demand. In terms of where you saw the best performance, enterprise software with that recurring revenue model that Paul mentioned, that's really one of the things investors like. It's very predictable. It's easy to see a path to profitability. CrowdStrike, who's here at the conference, was one of the kind of standout IPOs. And when you kind of look at their metrics around cost to acquire a customer versus lifetime value and the ability to expand their footprint with clients every year, great example. Cloudflare, obviously another great example of a very successful IPO in the enterprise software space. The other area where we saw a lot of acceleration, have seen more this year, is around health tech. So we've seen companies that have gone out that are in the healthcare space, not just biotechs, which are actually a big chunk of the overall IPO picture, but also then other opportunities to kind of change and make healthcare more efficient. I mentioned Accolade, who filed publicly recently. One Medical had a successful offering earlier this year, Change Healthcare. I think where you see some challenges is on the consumer names, right? So in the consumer space, where there's less of a clear opportunity to get to profitability, that's going to be a drag. Investors obviously want to see growth, but profitable growth. And then as you kind of look at the topics du jour around corporate governance, but how do companies kind of manage themselves? How do they have that oversight? And one of the really interesting overlays on all that has been the dramatic shift in focus to ESG metrics over the last 6 months. So the idea that companies shouldn't just be reporting their financial metrics, but also their environmental, social, and governance metrics, which is a major challenge for public companies, given that there's over 40 different frameworks. You've got over 1,000 different topics that people want to see reports on. So as a public company ourselves, we struggle with which of those metrics do we report on. How do we kind of think through that? And we actually launched an advisory service to help our clients think through those topics last year, and it's been one of the hottest topics. And that relates directly into, as you mentioned, some high-profile deals that maybe didn't have the best corporate governance. And we think that there's been this ongoing debate in the markets around should companies be allowed to have dual-class stock. The Council of Institutional Investors has been negative on that. Our stance has always been, if you disclose your governance model and if investors know what they're buying, they'll make a good decision. So I think that we've seen examples of that where people have put out governance frameworks where the street didn't want to invest in that. So we think disclosure solves a lot of issues.
And before I segue to other panelists, you mentioned ESG metrics. I think that's really interesting. We're seeing a lot of interest and activity around it. Perhaps for the audience, can you elaborate a little bit more on ESG metrics, any initiatives toward standardizing which metrics may be adopted, to what extent you are starting to see companies report and disclose on these types of metrics?
Yeah, I think one of the interesting things we look at is there is now this huge new net inflow of investing dollars. So as you look at the wealth transfer from baby boomers to millennials, it's been one of the areas of growth in terms of net inflows into actively managed funds. I think as we've seen the shift to passive, active managers are looking for ways to differentiate, so we see that as a big source of new inflows for active managers. And then even on the passive side, Larry Fink went out with his annual letter to CEOs saying that he views climate risk as investment risk. And ESG disclosure is going to become de facto part of the norm. I mentioned the 40 different frameworks. Some of the leading ones out there are MSCI, Sustainalytics, the task force on climate disclosure that Larry helped to chair, and then all the way down to SASB, which is a industry by industry framework that kind of identifies which metrics are going to be important for which industries. And as you can imagine, this is just a very confusing time, a challenging time for corporates. One of my favorite examples at Nasdaq, we got a negative score from MSCI because we did not have a policy on our website that we were opposed to human trafficking. I can guarantee you Nasdaq is opposed to human trafficking. But that's the way a lot of these frameworks operate, is they go and they scrape information off your website. And if you're not disclosing something, it doesn't get incorporated into their model. You get a negative score, and then it can affect the investors that you're able to work through. So that's a small example of a much broader issue, which is even companies that have been doing corporate social responsibility reports for years, like us, it's still now a major challenge to kind of go through and understand all the different nuances. And then when it affects the funds that can invest into your stock, it's a big impact.
So if there's one takeaway from today, make sure you update your websites to disclose that you're opposed to human trafficking. So, maybe Paul, transitioning over to you. You mentioned JMI's focus across B2B enterprise SaaS. What sectors of technology, and maybe more specifically software, are you finding to be attractive in today's market, in which we do have fairly high valuations and market volatility, notwithstanding that you're more of a long-term focus anyway, so not day-to-day, but what sectors are you finding opportunities in?
So it's hard to overstate the cloud. You know, the big, we've been investors in enterprise software going back to Alex Brown when we took Microsoft and Oracle public. JMI started doing enterprise software deals. We made our first cloud investment in 2004, was Eloqua. Our second one was 2005, ServiceNow. I wish we would have bought everything in that period of time. You know, if you think today, you know, the AWS business is a $40 billion business growing organically 30%. Salesforce is a $20 billion business. It's hard to overstate how big the cloud is. There's lots of ways to play it. There are replacement markets, and there's new markets. And so we think of it as any vertical, any horizontal. You know, there's lots of ways to play it. It's a 10-year, more than a 10-year trend. You know, the quality of these businesses is higher because instead of license maintenance, hope you made the quarter, there's lots of small customers, subscription revenue. Renewal rates are actually higher. You can make the products better over time. I always say, you know, my favorite app now is southwestairlines.com on my phone. It keeps getting better. I don't do anything. And I never call Southwest Airlines. I never use my computer anymore. It's easier to use your phone. And so there's some going to be thousands of great businesses that are built. The question is, how do you value them? And so the judgment at any point is, you know, what is this business worth today? How big can it get? And so we think about the multiple. The entry multiple is one factor. The enterprise value that you invest in is also a big factor. And how capital efficient is the business? So our niche is we like founder-owned businesses, generally in secondary cities where they've been capital efficient. Most of our deals are one-round deals. Sometimes we invest in horizontal companies where you're going to lose money to grow fast. But a lot of these businesses, you know, the unit economics, when they're small, you can really see what the cohorts are and what the renewal rates are. And so, but growth is never cheap. I mean, I've been at JMI for 21 years. It wasn't cheap in 1999. It's not cheap today. And so there's a lot of business judgment. But the cloud is a great long-term trend with lots of winners.
And Paul, you mentioned the cloud transformation across several verticals. Are you seeing certain verticals adopt cloud more quickly than other verticals? And does that thereby provide investment opportunities when we think across healthcare, financial services, transportation? You mentioned Southwest. Are you seeing more opportunities in certain verticals than others, or?
You know, in the end, we're investing in specific companies. So we meet 600 companies a year. We track about 100 of them. There's 25 that we'd like to invest in if we can get alignment with the founder. And they're across. It isn't one vertical. We don't like things where there's a commodity exposure. You know, there's some areas where you don't have as much budget. You know, we've done well in education, but education's tricky. You know, selling to businesses is a lot easier where people have budget. But there's a wide number of verticals and horizontal that are adopting SaaS. So it isn't. It's a big macro trend, and I think you can see venture people doing well, growth people doing well, and the buyout private equity people all have seen this macro trend.
And for many of the companies in the audience today, they may be sitting here looking at the macro environment, deliberating, is this a time to shift strategy? Should we build up cash reserves, go out and capital raise today, given we may be entering a period of increased market turmoil? What advice do you have for companies like that who are deciding, do we accelerate perhaps some of our capital raising plans, or do we stay the course?
You know, everybody has to run their own race. You know, our sales cycles end up being about 3 years. Generally, it's the founders. Kevin Landry, the founder of TA, had a great line. He says, we're in the business of selling money to people who don't need it. In our world, that's a lot of what it is. So part of it's just what's the right time for them, what's the right time for their team. So there's a bunch of factors that come in. But there's a ton of, if you have a growth business with a good business model, there's plenty of capital. And it's, so you should think about it. And I don't think it's going to go away. And the private market is not as volatile as the public market. And so I wish sometimes we could value things. We get both sides of it, but the private market is not going to move around like your market does. So if you have a good business, if the right thing for you is to raise money this year, you should raise money this year. If the right thing is to wait till 2021, there's going to be plenty of money in 2021.
One of my favorite descriptions of the private markets versus the public markets, it's like scuba diving 100 feet under the surface when there's a hurricane going on up top.
Yeah.
Maybe, Alex, shifting over to you, now that you've been a successful public company for about 6 months, what advice can you offer private company CEOs evaluating whether to go down that public company path?
If I can give advice, I can talk a little bit about our journey, I suppose. One question we asked ourselves a lot, I've been at the company for about 4 years, is why? Like, why should we go public? We had lots of opportunity to take on private capital. We did, I think, 4 or 5 rounds through our kind of 9-year history. And for us, it kind of felt like a natural evolution of the company. We've been fortunate enough to grow our top line at a pretty healthy rate. I think we've been pretty efficient with capital since we started. But kind of as you get bigger and as you start servicing larger companies, larger enterprises, and you start scaling your business, there's sort of a need, I think, to professionalize and operationalize not so much the engineering and product organizations or even the sales organization, but also kind of the what I think of as kind of the G&A function. So the finance organization, the HR organization, our security organization. And so we embarked on a project, I'd say about a year, 12 to 18 months before we even started the IPO process that we called Project Scalable, we called it internally. And we very much focused on scaling kind of those core functions of the business. I mean, obviously part of it was kind of looking down the road and thinking, okay, we probably want to go public at some point. But more than that, it was, let's build out these functions so that we kind of do put ourselves in a really good position to grow the top line, grow the business, grow the engineering organization for the next 5 or 10 years. And I think one of the great benefits of going public is that you get, I think customers start thinking about you differently, especially in the security industry. There's a lot more disclosure, obviously, about us as a company. I think we've always been a very transparent company. It's part of our culture. But the fact that you've kind of gone through this process, you file your S1, it's obviously very regulated, and so there's a different level of perception, and I would say even kind of an elevated level of trust, especially in the security industry. And so over the last, call it 12 to 18 months, I think our awareness has benefited from the process quite a lot. We started sort of what we call from the long tail, sort of protecting and accelerating everyone who's on the internet. That's a big part of our mission. And over time have kind of gone up market and are now servicing a large percentage of the Fortune 500 and the Fortune 1000. And I think the process of going public has helped us on the business front. So it still is a level of discipline that I think we benefit from. As you get a business that you put out there that works, it's important to become more efficient, and that process makes you more efficient. I think the flip side and kind of the challenge is how do you stay smart on kind of a 3 to 5 year horizon while you have to sort of meet objectives on a quarterly basis. But I don't think it's unhealthy, and I think so long as you're very clear about what you want to do and you very clearly communicate and then do what you say you're going to do to the market. For us, it was a very positive process.
And is there one thing that you learned or that you know now that you wish you had known a few months prior to going public?
That's a good question. So I think what we did well was bring people in who had a lot of that institutional knowledge. So we hired a CFO who was the CFO of Symantec, and then prior to that was the CFO of AMD and was the CEO of AMD prior in his career. And so he had kind of, this wasn't his first rodeo. Our chief security officer was the chief security officer of Uber, and then prior to that was the chief security officer of Facebook, reported to Mark. And so those are obviously two very important functions you want to have in place as you go public. Our head of HR was, I think, one of the early Twitter employees, had been there for a long period of time. So we brought in people that had sort of that DNA, that knowledge, had been through a number of cycles. I think we had a really good support from our banks going through the process. So the process was good. I don't know how you avoid this, but it always felt like when you do your kind of filings, we filed confidentially, once or twice, I think, before we filed publicly. And it always feels like there's this inevitable crunch, right, that you wish you could avoid. And you kind of you do your best planning, and then you're like, well, why is it always this urgent sort of last 24, 48 hours, or people at the printers doing this ridiculous stuff? But I'm not sure that's avoidable. And then, we wanted to be very customer focused in our communication, our messaging, in our prospectus. I think we probably underestimated, and we've got great customers that are very supportive of us, we probably underestimated the lead time that was required there to get everybody lined up. We ended up in a good place, I think. But there's probably more we could have done in our communication and our prospectus around having our customers advocate for us. And it just requires, especially with the sort of the Fortune 500, just requires a lot of lead time for a lot of these companies, and I think rightfully so and understandably so. So it's kind of, I think, one area where we probably would have started that, I don't know, 5 or 6 months prior instead of 2 or 3 months prior in the process. But and I don't mean to overstate that we kind of got everything right. We certainly didn't get everything right, but overall it was a good process for us.
Thank you. And Alex, you're also responsible for M&A at Cloudflare. Perhaps can you comment on what criteria you look for M&A acquisition opportunities? Not necessarily just specifically for Cloudflare, but in this market in which valuations are fairly high, how do you navigate opportunities to make sure you find the right opportunity, the right fit for Cloudflare?
Yeah, I can talk a bit about us, and then we actually benchmark ourselves. We did that about 3-4 months ago against companies like us, so kind of recently public companies that are, I think our market cap now is about $6.5 billion in the enterprise software space, and we found that the way we're looking at it seems to be quite in line with the way they're doing it. So I always think sort of strategy should drive M&A, not the other way around, right? So if you're out there, for the most part, if you're out there acquiring something, it should fit into kind of a plan that you have in general. One of our big assets is that we run a single software stack around the world. So I mentioned before, we run 200 data centers globally. It's over what's called an Anycast network. So all of our data centers run exactly the same software stack and can respond to the internet in exactly the same way. And that's very different from our competitors. And the advantage that brings to us is it allows us to have a very fast development velocity cycle. And it also creates a lot of efficiency, both on the engineering team, but also for our customers. So it makes it very easy for our customers to configure their network and their service, because they don't have to deal with different technologies when they're setting it up. What I mean by that is, for example, we offer a firewall through our network. We offer something called a denial of service protection. So a very common way that attackers will try to attack a website is by flooding it with requests. So we offer protection against that. We offer load balancers, rate limiters, all sorts of different technologies that require different pieces of software that our engineers have created. Many of our competitors have acquired those different technologies and sort of try to mash them together, but they operate on different networks, right? And that makes it very difficult for their customers to configure them. And so we have an advantage there. And the reason I bring that up is that then informs our M&A strategy. I'd be pretty skeptical if our team got very excited about a deal where we had to bolt on a different network onto our network, or bolt on a different technology that wasn't kind of incorporated, integrated into that single stack. So as a result of that, what we look for is technologies that are very differentiated. So what we'll do is, we're very security focused in kind of the different things that we do. And when we see something, when our engineering team or our corporate development team or anyone sees something that is really interesting that we think can be integrated into our stack very easily and in a very impactful way, we will go to the company, go to the team, and then we'll send our best engineers and say, is this something not obvious, right? Like, could you have done this, right? And so, if that's the case, if it's something that is quite different from anything else we're seeing out there, and the team has to be sort of pretty exceptional, those are sort of opportunities and candidates where we'll pay up for those, right? And we don't kind of, we talked about valuation before. Obviously, valuations, historical standards are high, but we're not quite there yet where we're kind of, valuing companies on, $50, $100 million revenue companies on a revenue multiple basis. We're kind of looking at the technology, trying to figure out, can we build it? How fast would it be to build? And often the rate limiter for us is people, too. Like, how hard would it be? Like, we acquired a company in Seattle last month that had built what's called browser isolation. So they're running, normally your browser runs on your device. They run the browser in the cloud and then send the request data, they send a stream of data back to your device, which then protects your device, right? It's a team from Microsoft, small group, 10 people, but the types of people they had brought together would be extremely difficult for us to go out and hire. And we're looking at another company right now, actually this week. It's a machine learning AI company in London. It's a handful of people from Cambridge University that, again, have done something not obvious, right? And we have great engineers, but to the extent you can bring together teams, that's also hard to do. They're doing something not obvious that we can integrate very quickly into our stack. That's our sweet spot, and we're willing to pay for those types of deals.
Great, great. Well, we're about to open it up to the audience for questions. One last question that I have for each one of the panelists, and then we'll have a microphone to go around for questions, is what is your biggest concern for your respective businesses in 2020? Maybe, Paul, if we can start with you and work down the line.
The biggest thing for us is getting the right teams. So we generally don't take market risk or product risk. We take lots of team building risk. And the correlation of getting the right CEO and the right executives for that CEO and good outcomes are very high. If we don't have the right CEO, the right team, and in this world, it's the talent. There's a lot of competition for talent. It's getting the best people at our companies sooner rather than later.
I think it's just if we entered an extreme period of correction where valuations adjusted very quickly, as Paul mentioned, especially on the private side, company founders don't always react as quickly as the public markets do. And so if you go back to, say 2016, when we had the last kind of bout of major volatility, one of the things we saw was not only did IPOs slow down significantly, election year, a lot of other big global economic events there, but then also on the private market, a lot of things slowed down. We do a lot of liquidity for private companies leading up to an IPO, both tender offers as well as one-off marketplaces to help companies organize liquidity for their shareholders. We started that business because we thought initially we thought it might be a hedge, where when IPOs slow down, companies would want to provide more liquidity. What we found was that when investors slow down on one, they slow down on both. And so we don't have a great natural hedge against that. I mentioned we do get the upside on better trading revenues, but in terms of the listings, the corporate client group, major corrections in the equity markets are just tough to weather. So we hope we get through this current scare quickly and get back onto solid footing.
I think for us, it's execution, and we're fortunate to be able to go public last September. So from a balance sheet perspective, we're in a good shape, and we don't hopefully expect to have to go back to the markets anytime soon. So for us, it's executing. It's executing on the business plan. Like I said before, it's doing what we said we're going to do, and we hope the coronavirus goes away as fast as possible.
I think we all hope for that. Perfect. What questions do we have in the audience? Yes.
Jeff, this question's for you. Thanks to everybody for being on the panel. Thanks for everybody for being on the panel. Jeff, can you shed a little bit of light on the SEC change in investor status?
Sure.
Accredited
So,
investors.
yeah. So the SEC recently put out for comment a proposal to change the definition of an accredited investor. One of the things you've seen is the private capital markets have expanded dramatically in basically a low yield environment. And so private equity firms, private equity funds, sovereign wealth funds provide a lot of capital into the private capital markets these days, which means that it takes companies a lot longer to go public. And so when companies take longer to go public, when they do go public, they're more fully valued. And so the returns, therefore, may not be as great. And so that's one of the things that Chairman Clayton is looking at very closely is how does Main Street America get access to the growth in private capital markets, given that today only people with $1 million in net worth or $200K in income for individuals, $300K for families can invest. So is that creating part of the wealth gap in the U.S., the fact that Main Street America can invest in private equity? Of course, what the commission has to balance with that is the topic of investor protection. So does Main Street America have the sophistication and the knowledge to invest in private equity? As Paul tell you, it's much more volatile and get a lot more zeros than home runs. But how do you do that in a way that's beneficial? So that's something that we're looking at closely and going to work with the commission on.
Yes.
On liquidity, can you talk about how the secondary market players like Shares Post and Forge and those are affecting what Nasdaq's doing, and if you're going to do the same thing, or maybe you already do?
Yeah, so there's a lot of platforms out there that help either companies or shareholders get liquidity. So I'd say the platforms you mentioned are probably good examples where they're working generally on behalf of shareholders. I think where Nasdaq Private Market's a little bit different is we work on behalf of companies. So a good example, we've got a company who's planning to do a direct listing later this year, and they've brought us in to organize the secondary market around the upcoming direct listing to help inform the reference price for that direct listing. So employees can go out and kind of identify investors either outside or within the platform. We'll then print all the trades, all the bids, all the offers on the platform to help to organize that. If you look at what happened around Slack and Spotify, they, took the trading restrictions off, and we saw a bunch of very wide prints, which isn't necessarily a great outcome for their shareholders or for the investors. So we think by centralizing secondary liquidity in the private markets, providing good disclosures, providing a good mechanism for price discovery, you can help to centralize that and make the markets more efficient, just as we do in the public markets.